Hello again. I think we left off in the Chapter 7 presentation on slide 18, and I didn't cover the last bullet, which had to do with size of the business. And size of the business can affect the effectiveness of the control system, especially in smaller companies, as has been mentioned. There simply may not be enough staff to adequately segregate key duties. In that case, compensating controls such as increased supervisory review and control over approving transactions may be needed. And even in the bigger company that I worked at before, we found that that was necessary in certain situations where certain sections had small staffs and had to do that sort of thing to compensate. On slide 19, several factors may cause smaller companies to be more susceptible to employee theft, as noted on page 392. More informality and trust, less structure and control, no internal auditors, and less ability to adequately segregate key duties, as we mentioned before. Slide 20 takes us into cash controls regarding cash receipts. Cash custody and recording are key duties that need to be segregated so that no single employee can do both. The text illustrates how this occurs in a retail sales business, where cash transactions occur on an over-the-counter basis and are frequent. It also discusses the handling of mail receipts and how they should be opened in the presence of at least 2 employees in the mailroom. The for deposit only stamp is critical in preventing potential fraud, since banks won't give an individual cash when this endorsement is provided. Over to slide 21. And here's a review of the typical controls used over cash: a 3-pronged approach of independent verification, HR controls, and physical controls. So you can look those over. On slide 22, continuing with cash receipts controls, this slide shows how the segregation of duties works in practice to prevent any one person from having custody of cash, along with the ability to record cash transactions. And notice how the accountant receives documentation from 2 sources: the cashier and the supervisor with the bank deposit slip and the cash register tape, respectively. And of course, those 2 documents should match. If they don't, this raises a red flag that will need to be investigated. The book does mention the cash over and short account as one that is used to account for cash shortages or overages, or situations where the cash register tape and the amount of cash deposited do not agree. Minor errors normally are just that and are not the result of fraud. Cash over and short is an income statement item that is reported as either a miscellaneous expense or a miscellaneous income, depending on whether there is a net shortage or overage. On slide 23, here are controls for cash received in the mail. Note how a copy of the receipt list is sent to accounting as a check on the cashier engaging in any potential fraud. On slide 24, this is an example of establishing responsibility to a select few employees. It is not an application of segregation of duties, because that would involve ensuring that cash custody and recording duties were not assigned to one employee. So here we're assigning responsibility to one designated person to handle cash receipts. So B is the appropriate answer. Slide 25, cash disbursements in today's world are increasingly by electronic means. Electronic funds transfer, or wire transfer, or automated clearinghouse, ACH transactions. Checks are still used, though, and must be adequately controlled, along with other types of payment. Most organizations maintain a petty cash fund for smaller expenses to avoid the red tape of going through the normal purchasing procedures. Although petty cash amounts are relatively small, there's opportunity for fraud without the proper controls over such funds. And now we move to cash disbursements on slide 26. In establishing responsibility for cash disbursement actions, approving new vendors and authority to sign checks are 2 important ones that must be assigned properly to a select few employees. Check signers should have no ability to record disbursement transactions. We've already discussed the the use of pre-numbered checks, and they must be used in sequence. I just did a test at my employer that identified out-of-sequence checks, and I had the staff confirm that all missing checks were in fact voided for valid reasons. On slide 27, before checks go out, they should be compared to invoices by an employee that did not create the checks or sign them. Blank checks obviously need to be secured when not in use, and check signing machines should also be tightly controlled. On slide 28, this is just a vignette about how employees steal. So I'll let you to look at that. Slide 29, the review question. This is a documentation control, since it's referring to using pre-numbered checks to help control their proper use. On slide 30, the voucher system is one that ensures the proper authorization and approval exist for each payment before it's made. With the increasing use of enterprise resource planning systems such as SAP, and Oracle, the way the vouchering activity is accomplished can vary, but the key aspects are the same. That is, an invoice must be approved by the right party or parties in order for it to get paid. On slide 31, petty cash funds, although small, need adequate controls to keep fraud from occurring. These controls are pretty standard across most organizations that maintain such funds. And we'll talk about the accounting for them in a while. So go to slide 32, the use of a bank. Obviously, most of us use banks or credit unions to help us handle our personal finances. So it should come as no surprise that a company's banking accounts and relationships are key to its cash management activities and its control over cash. Slide 33. In order to make the best use of a bank account, it's important to know how to read and interpret the bank statement and what it's telling us. In the banking world, for instance, debits and credits mean the reverse of what they mean in the accounting world. As shown on the slide, debits to the account reduce cash, while credits increase cash, which goes counter to what we've been learning in the class. Examples of each are shown. On slide 34, it's not up to the bank auditors to verify the correctness of the bank balance per the books. It's up to the company with the account to do that. The other choices are all control features of a bank account. On slide 35, in performing a bank reconciliation, we're comparing the balance from the bank statement to the balance in the general ledger cash account. There will almost always be differences at the time of the reconciliation due to the time lag between transactions recorded at each end and the company's or the bank's knowledge and or recording them. Some examples are shown on the slide. For instance, the company has recorded a deposit in transit on the books, but the bank has either not officially received or recorded it yet at the time of the bank statement. Certain checks written by the company have not yet cleared the bank, that is, they have not been cashed or deposited by the receiving party at the time of the bank statement, but the company has recorded the check payments in the cash account. The bank also has some items that the company has not yet accounted for, such as service charges, not sufficient funds or NSF charges, and so on. Of course, errors may occur on either side, as you may have observed in balancing your checkbook with your bank statement. Numbers can be transposed and so forth. On slide 36, to perform the bank reconciliation, you can start with either the bank statement or the balance per the accounting records per books, as long as the bank statement is available. This slide shows the adjustments needed to both the bank statement and the book balance to arrive at the current balance that should be in the general ledger cash account. Only the nature of the adjusting items is different. That is, the adjustments to the bank statement are items that the company has accounted for, that is, deposits in transit, outstanding checks, that had not made it to the bank statement, along with bank errors, if any, are observed on the bank statement. On the other hand, the books balance needs to be adjusted for items on the bank statement that the company had not yet recorded, such as collections on note receivable, if any, NSF check charges, service charges, and any errors the company made that are discovered while reviewing the bank statement. So the objective is to get to a correct balance on both sides of this, per the bank statement and per the books. And that way we can assure ourselves that the cash balance at the end of all this is correct. Slide 37. In this text example, there are 4 groups of reconciling items. Note that the first 2 are adjustments to the bank balance for deposits in transit and outstanding checks. And the last 2 are adjustments needed to the book balance resulting from a company error in recording a transaction and various bank charges and credit. So on slide 38, this chart illustrates the bank reconciliation and how, in determining the appropriate adjustments to both the bank statement and the balance on the books, a corrected cash balance is determined that reconciles both bank and book balances. So again, you can see the items that went into doing the reconciliation that affected the balance per bank, the deposits in transit, the outstanding checks, and then the items that affected the balance per books, an error that the company made on a particular check, an NSF check, a bank service charge, and then the collection of a note receivable. Now, as we move to slide 39, this is where it can get a little bit confusing. So let's review each part of this journal entry on the slide to see the rationale for each one. Starting with cash, this debit to cash is the result of adding the collection on the note, as you recall was $1,035, and the favorable adjustment from the error of $36, and then subtracting the NSF check amount, a deposit that needs to be taken off the books since the check failed to clear, of $425.60, and also subtracting the bank service charge of $30. When you do all that, I believe you should get $615.40. The bank fee expense is the sum of the service charge of $30 and the fee of $15 on the note collection. Accounts receivable is debited $425.60 to reinstate the account owed by the customer whose check bounced. The note receivable credit of $1,000 writes off the original face value of the note. The interest revenue credit reflects the interest earned on the note of in this case, $50. Remember the net amount collected was $1,035, so that was the sum of the $1,000, the $50 interest minus the $15 service charge, processing fee, whatever they called it. Finally, the credit to accounts payable is due to the error in recording the transaction, which led to a temporary understatement of both cash and accounts payable. So here's where our accounting equation comes into play again. Since accounts payable was debited originally for an amount that was $36 too high, the adjustment above was needed to restore accounts payable to its correct balance. It didn't have anything to do with what the company owed to the vendor, except to correct it internally. So if you understand all of that, you've come a long way to understanding how to perform the bank reconciliation and this associated journal entry to adjust the various accounts that are associated with it. And with that, we'll stop this part of the presentation.